Bosh, how's it going everybody? My name's TradeX, this is my trading den, and today we're going to talk about everything there is to do about standard deviations, alright? We're going to talk about my personal 3 strategies and the way that I implement them and how I trade with them. So without further ado, if you find value in this video, please do consider smashing the like and subscribe. It does the channel a world of good and it helps other viewers like yourself view this content. Without further ado, let's get the intro rolling and then we'll jump straight into the good stuff. See you on the other side. How's it going everybody? Standard deviations, and as you guys know how I like to teach, firstly we're going to start in the PDF slides, then we'll jump into the charts, and so at the end you guys will have an alley-oop, 360, slam dunk, absolutely everything you need to know about standard deviations, so you can jump into your charts and start executing for yourself. Okay, so let's start here on this slide, right? What are they? Put incredibly simply, they're used as a projection tool to dial in exits, right? So we'll have a standard deviation and then we'll extend out above that Fibonacci extension to get our price targets. And if that does sound confusing at the moment, bear with me because I'm going to break down entirely what my standard deviation settings are, so you can also get a copy of my standard deviations and my Fibonacci settings, so you guys are going to know exactly how to implement this in your charts, right? They can be used for implied ranges when used in the right scenarios. Again, this is something we're going to break down in the charts, but it's worth you knowing at this stage. They can be used as implied ranges for price targets within an intraday setting. Okay, we're going to break that down. They're used by the algorithm to reach certain price targets, therefore they are highly accurate, right? So as we know, and for those who obviously study ICT, we work on an algorithmic stance, right? We believe that the markets print algorithmically, and so the algorithm uses these standard deviations as price targets as it's moving towards a certain target. And for me personally, I use them as profit targets when I'm in a trade. So I can use these as places where I'll either partial off positions or where I am looking for the terminus on my trade, okay? And personally, used in combination with wider analysis to form up directional bias. And again, this is all stuff we're going to break down, but I want you guys to have notes so you can jot this down and so it doesn't all become too much, right? And then targets for trade execution. That's what I just mentioned there, so terminus and partials, all right? Now, what do I need in conjunction with standard deviations in order to use them for trades? Right, this is really important because you can't just plot a standard deviation in your chart and go bingo bash, off we go, I'm gonna run for this, right? As with anything in ICT, there is no holy grail, do this, do that, and it will work, right? You have to build a bias and you have to form it with other reasons as to why you would take that trade, okay? You can't just use standard deviations solely on their own. They are a tool to help you build an argument for price moving in a certain direction, right? So what I'm primarily looking for is liquidity on a higher time frame, whether that's in a discount or a premium, depending on where price sits. So again, this is something we'll break down in charts. But let's say, for example, we're in a discount of an hourly chart and we're expecting price to move up into a premium of a range. I would be using standard deviations to look and build confluence that the trade is going to reach a certain target. So for example, if it's a PD array inside a premium and we're targeting a fair value gap PD array, I'll be using the standard deviation to see if I can get a certain level inside that fair value gap, which dials in my entry. So for me, I'm using standard deviations to really dial in my exits, okay, my partials and my exits. And we'll break that down in more detail, so don't worry. And what we need to see a clear swing low form in order to present our standard deviation off of. So again, this is something we're going to break down in charts, but we're looking for a swing high and a swing low in between two short-term swing lows or highs, depending on the direction you're moving in. And again, this is something we're going to break down in the charts. And I'm going to break down the different strategies in the way that I use it. But if we're in a consolidated period and I've seen price reach a standard deviation, taking out the buy side, and I know what I'm looking for on the sell side, then I can use the standard deviation the same depth or the same target that it went out on the buy side on the sell side. And this is what usually happens when you're in search and destroy type scenarios. Okay, and again, this is something we're going to break down. And if we're looking for that target from discount to premium, premium to discount, and we're on a lower time frame, we are going to be wanting to see a very, very clear market structure shift to form our swing high and swing low, or swing high and swing low, depending on the direction we're moving in. And again, don't worry, this is all stuff you will understand once we jump in the charts. And if I'm in a trade and let's say we're on the 1 hour chart, we're in a discount and we're targeting a higher time frame premium in a range, okay? And say that's 60 handles. And realistically, it's great taking 60 handles, but you're more likely not going to take 2 contracts for 60 handles. So what I'd like to do is take partials en route. And what I'd be looking for are lower time frame liquidity pools. So buy side above old highs. And I'd be looking for standard deviations just above those liquidity pools in order to pay myself. And again, guys, don't worry, because we're going to break this all down in the charts right now. So guys, that's the PDFs done and out, dusted out the way. Make sure you make those notes and take those notes and jot them down. Let's jump into the charts and get into the good stuff. Let's get going. Going, everybody, we're inside the charts and we're going to start with this piece of price action which I've drawn. Piece of artwork, right? Some people might say it looks horrendous, all dependent on artistic preference, right? But the idea here is to give you an indication of how I use it in a fixed chart, and then we'll jump into some live chart examples so you guys can start building it all up in your head, right? What we need to understand is that standard deviations cannot be used solely on their own. We have to use them in confluence with other reasons. And today I'm going to break down a number of reasons as to why you would take a trade using standard deviations. Okay, so guys, please don't just throw a Fibonacci extension on your chart and go bish bash bosh, I'm going to hit buy. You've got to build a picture. As we know, ICT is not a holy grail. No one strategy or entry technique is a holy grail. We have to piece it all together, and standard deviations is a tool we can use in building that picture of where price is likely to draw to. So guys, where we're going to start is actually in the Fibonacci settings in itself. So what we have here is my Fibonacci, and a lot of people reach out and say, yo, X, can I have a copy of your Fibonacci settings? And yeah, that's absolutely cool, but it gets really tiring for me because I'm constantly firing out my Fibonacci settings. So guys, I'm making it very, very simple. If you want a copy of my Fibonacci settings, head over to my Twitter, and at the top of the page, pinned, you'll see a form. Fill out that form and you'll get all my future drops. Currently in there, you have my position size calculator, and you'll also get my Fibonacci settings absolutely free. Plus, if anything else drops in the future, you'll be first to be emailed that document, file, whatever it may be. Okay, so guys, head over to Twitter, fill out that form, takes 30 seconds, bish bash bosh, you have my Fibonacci settings. It's the easiest way for me to manage it long term, all right? But in short, we have 0 and we have 100. And what we're looking to do is starting to piece together everything I said in the previous slides now in the charts, okay? So it's not just slapping a standard deviation on the chart, it's building the picture. So what do we have here? Firstly, we know that we're in a discount and we are targeting a higher time frame PD rate. In this example, we're going to use a fair value gap inside an hourly. So this is a discount, price has moved up into an hourly OT zone, and we're using a fair value gap. Okay, so we have already formed a reason as to why price would move in a certain direction. Tick number 1. Tick number 2 is we just using a very, very simple entry model. So this is when price has moved out of that discount. We have a market structure shift, and we have this displacement leg form out of this market structure break. So we can now start using this displacement leg in between 2 short-term highs, right, as our place to extend our Fibonacci off. So we have a short-term high here and a short-term high. This is the middle pivot, and we're measuring that, okay? That is what we're measuring. Before the price has delivered, we are already eyeing this up. So say we didn't get in here, but we got in off this entry inside this OTE, and we were targeting this higher time frame PD rate. This is when I would start to use the standard deviations to plot my exits on my trade. So guys, I'm not trying to teach you how to trade entry. What I'm trying to teach you is how to use standard deviations effectively, because you can't just slap a standard deviation on a range and go, that is what I'm going to run for. You have to build it all together, and hopefully this episode here is going to help you do that, okay? So we know the reasons why now we would be using it, okay? So what else can we utilize to help form that directional bias? Well, here's a nugget for you, and I'm going to start dropping nuggets in my videos so the people who stay through to the end get the 3-course meal, right? They get all the juicy good stuff. And so here's one for you. I didn't put it in my slides for that exact reason. And I personally like to look for standard deviations between 2 and 3. That is how I use it. It's how I've always preached it. Anywhere between 2 and 3 standard deviations on a lower time frame is what I'm looking for as an extension, okay, as an extension. So we have 1 time standard deviation, and all of these lines indicate 0.5 of a standard deviation. So that would be 1 time standard deviation, that is 2 times standard deviation, that is 3 times standard deviation. Okay, great. So now I can see that I have both 2 and 3 times standard deviations inside of that higher time frame PD array fair value gap. In itself, you might say, okay, great. But what you could then do, if you're really cute, is jump down onto a lower time frame, so 1 minute or 5 minute, and look for, you could look for, an order block, a rejection block, a mitigation block inside of this higher time frame. And then you can use the standard deviation. This is where you're really starting to dial out your exits. It can literally be to a tick. As we know, prices are printed algorithmically, so it is likely to reach for these targets. Standard deviations is not a myth, they are real, okay? And so you guys have it. You have the 3 and 2 times standard deviations is what I personally look for, okay? That is another reason. What else do we have? And here's another nugget of gold, which has been put in my slides. We have, on the way to the higher time frame PD array, we have a pool of liquidity above old highs on the way to that higher time frame. So this here is liquidity. And what I'm looking for, and this is the true goal, is a standard deviation above that pool of liquidity. That is what I'm expecting price to reach up into. And especially if it's 2 times standard deviations and above, this is where I would be looking to pay the trader. Take positions off, okay? And you can see 2 times standard deviation, which is this level, is just above this pool of liquidity on the lower time frame on the way up to the higher time frame draw, which is this fair value gap inside a premium OT range, all right? So this is 2 times standard deviation. This is 3 times standard deviation. So how would I use this effectively? I would take off, for example, say I got in here with 3 contracts, I would take one off here, and I would allow price to retrace on me. If you want to know how I manage trades, I've done a trade management series, and you guys should, I highly recommend you guys watching that if you want to know how I personally trade. And it's the difference between not blowing account and blowing account, in my personal opinion, but take that information as you will, right? So I'll take 1 contract off here, and then I'll take a 2nd contract off at 3. Why 3, X? Because at 3, I am expecting price to reverse or retrace more deeply from that level, okay? That's another nugget for those of you who are watching through this entire video, okay? So we know at 3 we're likely to see a level of deeper retracement or reversal, okay? So I would take my 2nd contract off here. Then I would allow my 3rd contract the potential to run up into a different dealing range, to punch through old highs, okay? So that's how I personally manage trades, but if you don't want to use that, that's absolutely fine. Now, here's another piece of information I'm happy to share with you guys, and again, it's another nugget. I personally would like to see Confluence with another standard deviation to give me further confirmation that the algorithm is printing to those levels. So again, guys, that's another piece of gold for you. But what I would do is go back through the price action and look for another swing low to swing high in between 2 pivots with an aggressive displacement, and I would measure that range out. So what we're going to do is we're going to measure this, and we're going to look to see what we get. Okay, so again, swing low to swing high before the aggressive displacement higher. Aggressive displacement higher, aggressive displacement higher. What do we have? Okay, great. Here, at 1.5 standard deviation, we have Confluence with this swing at 2 times standard deviation. This is another layer of Confluence using standard deviations as a price target. If I see this, this gives me absolute confidence and a lot more confidence in using these as levels. Okay, so guys, you now know my very, very basic way that I use standard deviations. And again, if you guys want to jump onto my Twitter, you feel free to have my exact settings and you can start seeing. And to be fair, it'd be cool to see your charts on Twitter using my fib. They'd be cool to see. So guys, we're going to now jump into the real charts and we're going to start looking at some actual executions and some trades. All right, so let's head over and have a look at that. Okay, so here we go, guys. We're going to start building it up and having a look at it in physical charts. All right, this is actually a trade I took on Friday. I was trading the SPX 500. because my internet was down, so I was trading off a phone. It was a wild experience, but it was framed using everything I've just taught. So we were inside a discount at this level, right? We'd come down to this level. I'm not going to talk about as to the reasons why, because it made the video too long, but I did call out this area, and I was looking for prices to reverse off this level. So once price had reached that discount, what were we looking for? We were looking for price to do what? Return up into a premium. Okay, cool. That in itself is not enough, right? We need to be looking for what is price likely to be drawing to. Well, we had this fair value gap inside of that OTE zone. So now we're starting to dial in where price is likely to draw to. Now, we saw this this price leg here, okay? So before the displacement higher, we can measure this leg out. And I didn't take this trade, I got in down here, right? So what did we have? We had 1 time standard deviation, we had 1.5 times standard deviation at my target, at my draw, okay? Now, I'm looking at the next leg down. When price moved back down, and I can explain this whole reason why I took this, but I'll keep that for Red Pill members on Monday, but price returned into this level. And it's at this level you'd be looking to extend price out to targets, looking for areas of confluence on standard deviations. This is everything I've just taught you in my basic form of using standard deviations, in a real example, okay? This isn't actually 2 times standard deviation or 3 times standard deviation, but it is at a higher time frame premium target, so you could utilize these as draws, okay? Now, this is a 1 minute chart, and we drew out this fair value gap. And the reason being is because if we went to 2 times standard deviation, it would take us all the way through these highs. And then you have to start building in time and price. And where were we? We're at half 3. Is it likely to get all up and take these old highs out? No. So this is when you can start, dialing back your expectations and look for lower standard deviation. So guys, we had 1.5 times standard deviation on that swing. And then what did we have here? We had 1 time standard deviation. Did we get confluence across those 2? Yes, sir, we did. And what did price run up to? To a tick. To a tick. What did price run to a tick? It ran to those standard deviation levels. It actually ran through the target, which was to fill this fair value gap inside of that OTE zone, inside of the premium of this displacement leg, and ran up to a tick of those standard deviations. All right, guys, that is a first example of using standard deviations in confluence on swings before aggressive displacement legs, which I've literally just shown you how to use. All right. In a discount, moving into a premium, looking as a first place you could have taken partials would have been here, right? At 1 time standard deviation and 0.5. So if you got in down here, you'd be targeting this level here, right? Above this pool of liquidity, all right? Why? Because we had a small fair value gap in here which hadn't been rebalanced fully. So on the way up to that fair value gap inside the OTE zone of a premium range, we could have paid the trader here. So if you got in down here, pay the trader, right? Everything I've just explained in the previous slides. So that is going to cover one strategy I use. So that is using standard deviations on swing lows before aggressive displacement legs, and then looking for confluence between 2 swing lows, okay? And I've just showed you how you can use those range extensions up into premium areas, okay? And then you're looking for targets using PD arrays, and then you're using the standard deviations to dial in your targets, okay? That's strat 1. Strat number 2 is slightly different, and what we're looking for me is this is slightly more technical, but it's harder to implement because they don't happen every single day. Guys, this does not happen every single day, and as I said, you cannot just use standard deviations on their own, all right? You have to use them in confluence with other reasons. But I'm not going to go through every single reason today, that's not the purpose, but the purpose is the use of this standard deviation, and this is using implied range. And the reason why I use this implied range is because we're expecting and we're seeing price peg up continuously to reach for a certain level. So when we have this, and this is how I personally use it. You can use this entirely different, but this is how I personally use implied range. So when I see sell side liquidity taken, and we're inside a PD array, and we're expecting price to move higher, and then we witness this price action where it's continuously pegging up with no willingness to show signs of reversal, I will look for implied range moves for price targets, okay? Guys, that's another piece of gold for those of you who are sticking through this video, okay? So we have this low and we have this high. And what am I taking? I'm taking the range before 8:30. Okay, so I'm looking at the most relevant swing low and swing high before 8:30 and up until 8:30. Okay, so what do we have? We have this range here. What also is important is that we've swept sell side. Okay, and there's other reasons as well, but I'm not going to go through absolutely everything today. But this is how I would use implied range in the basic form. And so I'm looking at the price range before 8:30, the most relevant swing low and the most relevant swing high. And I'm extending that out. And then when I see this price action, which is continuously reaching for a higher time frame target, I can then use these implied ranges. This is 1 times in, well, I've actually got it marked out here because I traded this. We have this at 1 time standard deviation. Okay, so this is the range, that's 1 time standard deviation. And you can see how price was respecting these levels. This is actually in confluence with wick gaps and wick quadrants, but that's a completely different topic, all right? So if you're seeing these dotted lines and wondering what they are, that's what they are, all right? So that's 1 time standard deviation. What is my other standard deviation that I am looking for in generality? Well, it's 2 times standard deviation, right? That's where I'm looking to take partials. And there we have it. 2 times standard deviation using implied range. And guys, what did it hit to a tick? 2 times standard deviation using implied range. And at 2 to 3, we're likely to see a level of reversal or consolidation or retracement. And what do we get? We got consolidation, okay? So guys, that is my implied range using standard deviations. There is one more, and we're going to jump into that right now. So number 3, very, very briefly, is when we're in periods of consolidation and we're expecting search and destroy type scenarios and price delivery, I will use standard deviations both to the buy side and to the sell side when price is just looking to whip out both sides, okay? And so I'm looking for a range with relative equal highs and extending that out. And I'm waiting for what price does. So say, for example, this is a set target that I was expecting price to reach up to, and it tags, but I didn't trade it. But I'm expecting search and destroy to price to run in the opposing direction. I am wanting to see what standard deviation that it hit. So in this example, it was 1.5 times standard deviation. I'm then going back into the consolidated period and looking for relative equal lows, and I'm extending that out, and I'm using the exact same price target. And so you can see here, price ran down to 1.5 times standard deviation down towards the sell side. And so I actually traded this day, and this was a day that everyone got really, really confused on Twitter, but I ended up taking about 52 handles this day. And it was because I was expecting price to come down to this 1.5 times standard deviation before moving higher, all right? So guys, that is going to cover absolutely everything I do with standard deviations and how to use it in the chart. So as always, guys, if you find value in this video, please do consider smashing that like and subscribe. And until next time, trade safe, trade smart, and I'll see you on the other side. Take care.